Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Saturday, December 28th, 2024. As I expected, the stock market recovered most of its loss after the Fed revised its policy rate dot plot on December 18th. That afternoon, the S&P 500 index fell more than 3% after that decision was announced. However, it recovered nearly all that loss 6 days later to close less than 1% off its all-time high. So here's the S&P 500 year to date. Let's go over here to the right, and I'm going to zoom in now to the past month. And here we are, start of the month, cruising along fine, and then the day that the Fed announced its policy rate cut 10 days ago, the 18th, you can see the big drop. So the good news is we're less than 1% off the all-time high. The bad news is Wall Street appears to be concentrating its money again in the same large cap tech stocks that it flees to for safety whenever it starts to get nervous about the economy. Now, so this is the S&P 500, which remember is it is not equal weight, it is cap weighted. So a company whose total value of its stock is say 10 times greater than another company, well then its performance weighs 10 times as much in the formula for the S&P 500. But as I've mentioned in the past, there's also an equal weight version of the S&P 500 that most people don't talk about. And you can invest in it through this exchange traded fund here, the Invesco S&P 500 equal weight. Now look at over here to the right. Now this is year to date for the RSP. It's down in more than 5% from where I have the cursor right now, roughly around the start of this month. And look at this. Look at the magnitude of that drop off over here on the right. Compared to, let's go back to the S&P 500, and we'll do year to date, so the charts are on the same scale. And you can see quick sell off there, but look how much it recovered versus the equal weight. Only a tiny little recovery there, but still a much more severe reaction to whatever's been driving the market for the past month. Now, that does not necessarily mean Wall Street believes the stock market is about to crash. If it did, portfolio managers would not be buying any stocks at all. Instead, they are pursuing a survival of the fittest approach to the stock market that emphasizes cash flow and revenue growth over profit margins and earnings. Now that inference is confirmed by the behavior of the small cap Russell 2000 index, and here's a chart for the Russell 2000 index year to date, which is down more than 7% during the past month. So again, here's that same peak around the end of November, and look at the big slide and then a tiny bounce. The shape of that chart looks similar to the equal weight, but it does not resemble the cap weighted S&P 500. So here you go, cap weighted, equal weight, small cap stocks. And by the way, these stocks are not included in the S&P 500. These are smaller and mid cap stocks, but you can just see the pattern of Wall Street pushing its money kind of uphill towards the mega cap stocks. Now, also, the Russell 2000 now, if I draw a line back here, this dotted red line, it has gained no ground over the past 5 months. And now this big spike here was shortly after the second quarter GDP, gross domestic product report came out for the second quarter that was much stronger than expected. Since then, the Russell 2000 had a big drop, and then it recovered nicely. Now, after the most recent drop, it's right back to where it was 5 months ago. So what is it about the past month that has Wall Street back in a risk-off mode? In a word, uncertainty is the explanation. In addition to the normal amount of uncertainty that is always present in the stock market, we must now contend with the new presidential administration that is sending mixed signals to Wall Street on which way it will go in terms of trade tariffs, energy policy, immigration, and taxation. That is always the case when there is a change in political leadership. So I'm not too concerned about how Wall Street is reacting to what I view as a normal sequence of events. You may recall there was a lot of hand-wringing on Wall Street when Biden took office 4 years ago, and since then the S&P 500 index has delivered a total return of more than 60%. So if we go back here to the S&P 500, we go back 5 years, which goes back to the last year of the Trump administration. Of course, this big drop right here is when COVID hit. Biden took office, January 2021, and of course there was a lot of chaos around you may recall the events of January 6th of that month, and all the concern. But look, and for a while, it took a while for the stock market to really get going. But once it did, it has performed extremely well. So that's why I don't read too much into Wall Street's ennui over the economy. Yes, a lot of things could go wrong next year if the Trump administration is not careful. However, a lot of things could also go right if it can avoid getting bogged down by internal squabbling. So let's hope that is the case. The world is fatigued after several years of pandemic, war in Ukraine and the Middle East, and political rancor over how best to deal with those events. It's time to move on. Thank you. That's this week's PF Update, and I look forward to talking another week. Have a great new year, and get back at it in a few days. Thank you. Bye.